Hi again from James Turp at Absa Investments. I've got a brief update to add to the presentation you've watched today on fixed income themes. Of course, since the recording, we've had a massive geopolitical event that we kind of forecast in the presentation. Of course, Russia going into Ukraine and asset prices globally reacting. So I want to just take you through a few refreshed slides, most importantly, how markets have responded so far. But also, I need to say, consistent with the title of the presentation, that asset prices will, of course, react. We need to not overreact as investors as well. We de-risk our portfolios a little bit, but it is also important, as we learned in 2020 with the advent of COVID-19 and how markets locked down, you'll remember equities at a point halving in value in some cases, and within weeks thereafter, once the extent of the crisis was more understood, markets rebound again. So it is important to stick with your investment strategy, of course not blindly, be aware of developments, but try not to overreact. And in fixed income, you are in good hands. You're in the low risk asset class, not without risk, of course. So let's take a look at some of the reactions at least. Now, of course, we were anticipating this. And I think similarly to a lot of things we've seen in history, such as Brexit, the Trump winning the US election, these things were broadly unexpected to happen. And I think the market was quite caught unaware by this. And that's why we've seen such an aggressive response from asset markets. But firstly, I'm going to show you the currency. And this is a chart you would have seen in the presentation today. And just look in purple, the Russian ruble devaluing today, 36% of its value lost as SWIFT, that is an international payment system, SWIFT transactions with certain Russian banks have now been stopped. So all these sanctions that are being imposed on Russia coming through in the currency, of course, ultimately, this seems to benefit the US dollar at the moment, with Europe's close ties to Russia, with the gas being supplied to Europe from Russia. It does seem like currencies are going to weaken against the dollar for at least the short to medium term. I've got here a chart of bonds that we would have looked at. And at the time, South African 10-year bonds were second highest in yield. You've seen the orange line there with Russia moving up to 16% on their 10-year local currency bond. There's default starting to be priced in a little bit too. We saw Russia raise their interest rates this morning 10% to 20%. So we've got short-term Russian rates at 20% at the moment. And here you can see their 10-year local currency yields at 16%, taking protective action here. But this is causing turmoil. Of course, still our bonds have reacted, but not as aggressively, of course, as some of the other emerging markets you're seeing there. We must look at them on a real basis as well. Now, we were second most attractive at 4%, now third most attractive with Russia at 7.25%. I wouldn't think it's a good investment to be in, but it just shows you how all the charts being kicked out of register from where they were. Inflation break-evens as well. These are the US ones we looked at. Interestingly, the 30-year moving lower, but the others moving a little bit higher, sort of wobbling around there. But you can see those. I think more importantly, if we look at our own inflation break-evens, they shot up over the last few days, correcting a little bit, but we want to keep an eye on these as well. And then final point to make about this, a big risk globally for fixed income could be monetary policy error. Now, we've got this theme of normalization that we discussed in today's presentation. The Fed expected to kick off normalization. Now, they really need to take into consideration this rapidly changing situation that has been introduced by Russia's invasion of the Ukraine. And we need to be aware of policy error. It's difficult to forecast this as well, but this is a major new risk that is introduced, that the oil price that we spoke about as well, it's currently sitting above 100, moving in on really high territory that could influence global inflation. We don't want, we would hope not to see an overreaction from policy normalization in the short term, stifling economic activity. These are all things to be aware of. Remember, once again, today's presentation was more a theory of themes and how we use fixed income curves and asset prices to give us an idea of what markets are telling us and are discounting. So the themes and theories still hold, but we just need to overlay some of the levels that were presented to you today have changed, of course, in line with this global risk off that has occurred post-Ukraine invasion. Thank you very much for watching this. I hope you enjoyed the presentation, and we'll be in touch soon. Thank you. Bye.
Hi there. My name is Asanda Noche. I am the Chief Investment Officer at Mazi Asset Management. The current situation in Ukraine is very concerning for us, and we add our voices in imploring global leaders to speedily find resolution to the situation, as it will lead to a very bad and unfortunate human crisis. From an investment perspective, our experience indicates to us that we need to complete or continue to apply a very disciplined approach in terms of the application of our philosophy and our process. In that regard, with respect to research, we look to understand the underlying value of assets on an ongoing basis and have a very clear view of what that is. And so when opportunities arise, and in instances such as these, it's that understanding that enables us to identify opportunities, but also not to unduly panic and react irrationally. Two examples in this regard are Mondi and Bolo. So, and as an example, in the case of Mondi, we don't have the company in our portfolios, but as a consequence of the fall in the share price, as a consequence of the resulting crisis, our analyst is able to give us an indication of what the updated value of the company is, especially considering and taking out the value of the assets in Russia and Ukraine. So as a consequence of that understanding, we are able to identify or assess whether there's an opportunity from an investment perspective. Similarly, in the case of Bolo, we don't have it in the portfolios, or sorry, we do have it in the portfolios rather. But again, because we understand what the value of the company is, we're able to react rationally in terms of remaining invested, because we still believe that there's substantial value, and the impact of the exposure in Russia is relatively minimal, and remains, and therefore the group remains an attractive investment going forward. At a portfolio level, we, in addition to constructing and putting together our portfolios based on the underlying research from our analysts, we also employ a detailed risk management framework in terms of understanding where we've taken risks. So specifically, our focus is to understand and to analyze where specifically risks are taken, with the view and with the objective of minimizing and effectively diversifying away the risks that relate to any other factors other than those concerned with the underlying companies we're involved in and that we invested in. So as an example, we wouldn't want our portfolios to be driven by non-fundamental risks, such as, for instance, the crisis that's happening at the moment, the impact of things like interest rates, currencies, and so on, and other sort of macroeconomic or geopolitical type risks. Because our focus in terms of where we've taken a great deal of understanding and time to identify opportunities is on the individual companies, as opposed to trying to forecast where the next sort of disruption will come from a global sort of geopolitical perspective. And so in that regard, we use these risk management models to understand how we should construct our portfolios in order to minimize the impact of these outsized or outside risks. So an example in our portfolios that in terms of what we've done in response to some of these risks and things that and sort of things that we've done in prior to this happening at the moment is the inclusion of some of these safe haven assets such as gold. In our case, we've got some of the gold companies in the portfolio. Now, that inclusion of gold companies is a recognition of the fact that the world does have, or we are in the midst of a number of fairly significant mega trends, be it geopolitical, political sort of power shifts in terms of the East and the West. We've got aging populations, increasing inequality, and so on, and low interest rates and low growth environments, unemployment being a concern in many parts of the world. And so as a consequence of some of that, or that recognition of some of those factors, we do believe that there is a need to protect the portfolio against the potential for some of these movements, and hence the inclusion of some of these safe haven assets. And so in conclusion, our focus remains at this point, as difficult as it is, on the application of our philosophy, both in terms of ensuring that we identify attractive opportunities from an investment perspective, as well as making sure that we don't overreact irrationally and therefore crystallize losses for our clients at exactly the wrong time, but also ensuring that our portfolios continue to be driven by the kind of risks and sort of the focus for us being on the risks that we want to be exposed to, being the underlying companies that we've researched and that we understand, as opposed to being influenced by things that are out of our control, and hence the actions that we take on a continuous basis to make sure that the portfolio is actively and well protected against some of these objectives. Thank you very much for listening, and I wish you a good day. Thank you.
Good day. The topic of my presentation was on volatility. I used the imagery of a tsunami disturbing calm waters, and for those who listen, this was not specially premised on the Ukraine-Russian conflict. This is a dramatic event which has only served to exacerbate volatility. If we look on the chart, the Russian equity market has halved and has been closed for trading, which is an event which is still unfolding. The Russian currency has lost almost 40% of its value, and Russia hasn't been able to service its debt worth $29 billion as payments have been frozen. And this has increased the risk of a sovereign default. Russia matters because it is the 11th biggest economy in the world, with Ukraine at less than 1/10 of its size, but really still an important player in the metals and commodities market. If you look at the chart, you can see that Russia is a major exporter of energy and metals. It produces 40% of the world palladium, 12% of the crude oil, and roughly 20% of wheat, really the breadbasket of Europe. With 40% of European gas coming from Ukraine, we have seen massive volatility in the commodities markets, especially in natural gas, which has spiked by 60%. Also, the oil price year to date has gone up over 30%, and a number of commodities likely to be impacted, hard and soft, are likely to see their prices going up, further fueling inflation. On the other hand, and good news for investors, South Africa has become a relatively safe haven, with resources counters benefiting. If you look at the chart, the line in green shows the JSE in dollar terms. Our companies continue to benefit from strong earnings and have exceeded expectations. But stock picking remains key. While our commodity exporters are likely to benefit, companies with operations in Russia like Barloworld and Mondi have been punished. One has to be quite judicious in selecting the right counters in an equity portfolio. Once again, I'd like to reiterate that the thorough investment process where companies with solid business models is the best way to navigate volatility. At Ashburton Investments, we believe that this year is likely to be different from last year. We need to be fleet-footed and adapt to an increasingly hostile and volatile economic environment. Thank you for listening.
Thank you. Good morning and good afternoon, everyone. The whole point of this update is to discuss the horrible tragedy with regard to Russia invading Ukraine, and just to inform clients what is actually going on in oil and gas markets. Obviously, our concern at foremost is the human tragedy aspect of this, but this is for information purposes only. So just to give you that clear message. The first message on the oil markets is, and gas markets, is before this tragedy, before Russia decided to invade Ukraine, it was very, very clear, and there's probably no coincidence in this, it was very, very clear that both markets were already very, very tight. Gas market in particular, actually, is much more tighter than oil markets, and the gas market in particular has a lot less flexibility than oil markets. And I'll explain what I mean by that in a few minutes. The first thing in the oil market, which is about 100 million barrels a day at the moment, 12 million barrels a day of that, just under, is effectively what Russia supplies into that market. And 5.5 million barrels a day of that is exported by Russia. Now, some of those exports in the short term will be impacted by clients self-imposing on themselves to not actually buy Russian crude. At this point in time, there are no restrictions on payments with regard to energy flows between Russia and other parts globally. But obviously the restrictions are using dollars and euros. And some clients have decided to say, we will not be taking Russian product in the crude market. This in the short term will obviously cause a spike in oil prices. And it's not inconceivable to see oil prices rise to $150 a barrel in the short term as a result of this. That spike in oil prices is not necessarily due to just hoarding. What will be adding to this spike is the paper market, which, little known fact, is 20 times the size of the physical market. So that's the first thing. The second thing is that don't be surprised, though, to see Russia potentially use other avenues to basically export its crude. Potentially, they could sell crude into China if China was willing to basically buy that crude, despite the self-imposed sanctions elsewhere, and also India. In addition, in the short term, we would expect to see probably an Iranian deal being signed, which probably could alleviate some of the pressure on oil prices as we head into the second half of this year. Because Iran is sitting on quite a lot of storage, about 85 million barrels a day, 85 million barrels of storage, which could be fed into the market over a 6-month period in the second half of this year. And that would help to basically alleviate near-term price pressures. But again, coming back to the bigger picture in oil markets, the oil market has suffered a significant amount of underinvestment over the last 5 years. So don't expect oil prices to collapse back to the $30, $40 a barrel again anytime soon. But we are approaching levels on prices where demand destruction could potentially occur. If you actually add up oil, gas, and coal prices, so conventional energy as a percentage of GDP, we're now approaching 8% of GDP. This has happened twice in history, 2008 and back in the early 80s. And both times we were followed by a recession when this occurred globally, because the cost burden on the consumer, residential and industrial user becomes too much. So what you get is demand destruction. We're approaching levels within the energy complex where demand destruction is likely to occur. It's likely to occur in the oil market, and that could be a regulation for that fixing of the supply and demand balance. The other area where it's going to occur is in the gas market. And the reason I say it has to occur in the gas market is because there is very, very little flexibility in the gas market right now. Prior to this conflict, inventories were below normal in Asia. Inventories were below normal in North America, which is actually abundant of gas in terms of supply dynamic, and well below normal in Europe. And again, there's no coincidence in the timing of this move from Russia invading Ukraine with the gas market in this situation. But the gas market has suffered even more in terms of deferred projects versus the oil market. Projects were deferred in 2019, pushed back for 2 or 3 years because gas prices were $2 an MCF. Projects were deferred again in 2020 because of COVID. These deferrals mean that if we were to start the projects in terms of engineering and constructing the projects right now, we wouldn't really see a supply response until 2025, 2026 at the earliest. So what does this mean? Gas prices have gone from $2 an MCF in 2019 to now just under $40 an MCF in Europe and in parts of Asia with regard to LNG import prices. This will flow through into consumers' bills in Q2 of this year globally, in the form of basically high gas prices for the gas we use to heat our homes, and also high electricity prices. And it's not just the residential consumer, it's obviously industrial consumers which will have this impact as well. Net, we see no near-term fix for the gas market outside of essentially demand rationing. And this can happen in industry, and it also in the form of obviously the consumer basically using less gas to heat the home and cool the home as we go into the summer. So to conclude with two core takeaways from what is happening at the moment, there is a potential supply alleviation as we look for the second half of the year for the oil market, but unfortunately there is no near-term fix. There is no near-term fix for European gas and electricity markets without demand destruction. Further investment in global gas markets will be needed over the next few years in order to diversify supply away from Russia, while at the same time causing the least disruption to industrial and residential users of energy, because the need to reduce coal-fired generation is still very much needed globally at this point in time. However, the most dominant theme from all of this is the events of the Ukraine will only speed up the energy transition. Energy independence through cheap and sustainable power will be at the forefront of every policymaker's decision-making process from now on. That is the most important message, because power generation through solar and wind is significantly cheaper than nuclear power generation, and it's way, way cheaper than coal-fired and natural gas-fired power generation at this point in time.
And welcome, it's Bastian from Prescient. Thanks a lot for joining us. We are going to speak just 5 to 7 minutes about the Ukrainian crisis. So before I even start, a quick disclaimer from our side. So we're not going to speak too much about politics in this obviously very political event. We want to keep it neutral. At the same point in time, I do want to highlight that we are highly concerned around the humanitarian situation which we are facing in the Ukraine right now. We're not going to touch on that. It is our job to focus on economics. And as you know, at Prescient, we are very data-driven and very sober with our economic assessments. So we want to keep it neutral and factual as far as we can. And we will, basically have the data speak within this presentation. So before I go into the details, we are going to focus very heavily on financial conditions. And there's a reason for that. First of all, because asset prices have not moved too quickly yet. So purely from a top-down point of view, we would not see a significant change in market valuations. And that applies actually almost across asset classes. Secondly, we do think that the economic impact is also going to be muted simply by the fact that the Russian economy is just a very small portion of global GDP, and that we do think that the trade implications globally will also actually be not as of that much significant as we actually see it in the headline. The true risk clearly sits within global financial conditions, and we have seen European banks having sold off quite heavily, at least once one looks into the equity prices. But at the same point in time, we want to paint a positive picture. So we want to highlight that while we see the sell-off and we look at the circumstances cautiously, we're not picking up any significant financial stress globally, which is obviously a quite positive sign that this global crisis can actually stay potentially quite local. Okay, so straight into it, I'm going to start by once again highlighting we do see this crisis as a serious geopolitical event, very significant, actually most significant geopolitical crisis since the Cuban Missile Crisis. That is important to highlight. At the same point in time, we do expect short-term market reactions. So we can already see equity markets moving faster. We can see that implied volatilities are picking up. Credit spreads are slowly starting to widen. But at the same point in time, these are all very muted reactions. We actually expect these muted reactions to stay quite muted. And I mean, if we look into the rand right now, it's strengthening against the euro, it's strengthening against the pound. If we look at South African equities, we are printing new all-time all-time highs. So far the story plays out the way we would expect it to play out. But now straight into the indicator set which we are measuring. I'm going to start on the right-hand side by looking at the LIBOR-OIS spread. The LIBOR-OIS spread is measuring the difference or the spread between LIBOR and the overnight interest rates swap rate. So LIBOR is just the rate at which the biggest banks globally lend each other cash. So high quality credit with a very short duration. So interest rates shouldn't be high here. We shouldn't price for a lot of credit quality, but then we're comparing it against the overnight interest rate swap rate. So by doing that, the overnight interest rate swap rate doesn't contain any credit risk because there's no exchange of capital, but it's pure interest rate expectations. So by measuring this spread, we can basically drill straight into the funding pressure and the credit quality of these high quality biggest banks globally. And if I look at this on the chart on the right-hand side, you can see a massive spike, obviously, during the great financial crisis with the collapse of Bear Stearns and Lehman, a crisis which took quite a while to get under control. We can then see that there's also a spike during the European sovereign crisis a little bit later. And you can see that during COVID-19, we see a massive spike. What are we seeing now in the Ukrainian-Russian crisis? You can see almost no spike. So don't want to sound complacent, but the impact on the funding system itself is very, very muted as we speak. Let's take it one step further, one step up the risk measure. So now we're looking at credit spreads once again, but now we're looking at credit spreads with a longer term, roughly 8-year term on US investment grade credit. And obviously still investment grade, but not as high the credit quality as if we look at only the biggest banks globally. So what do we see in credit spreads? Credit spreads have once again spiked significantly during the great financial crisis, where bigger corporations started to be priced for default. We see again the same during the European sovereign crisis. And then, look at this last spike here during the COVID crisis. You can see a massive spike. Market participants started to price credit markets for a freeze, which means investors would seriously be concerned around the ability of these big corporates to repay their debt in time. What happened after that? Central banks came into the system, deployed enough liquidity, calmed the situation, and spreads removed to normal quite quickly. Where are we right now? Well, we see credit spreads on the rise slowly, but if you look at the chart very carefully, we haven't even seen the start of a significant spike. So again, disclaimer, not taking the situation too easy, just saying from a financial conditions point of view, we do not pick up those major stresses as one would during a serious geopolitical crisis. The crisis so far has remained pretty local when it comes to global credit markets. Last indicator, and this is probably the most severe one, where we're drilling straight into financial stability and the global central bank's ability to basically keep the financial system afloat. We are looking at the EONIA versus LIBOR, basically the overnight cross-currency basis. So what this tells us is basically what is the clean swap from the basis of an interest rate swap, swapping short-term floating rates in euro to short-term floating rates in dollars. So this swap should be given the very, very, very limited credit risk, almost basically no credit risk. This swap should basically have no basis, i.e. be a flat line, basically at a very low level. Having said that, what we observe during periods of severe stress, that there might be a dollar shortage, so that there is maybe a run for US dollars compared to euros, or compared to other currency pairs. So that basically people are trying to get their hands on to basically hard currency dollars, which is probably arguably one of the strongest haven currencies. Are we observing a spread in this spike in this spread right now? The answer once again is not really. So yes, we have started to see some move, but as we speak, we are already rebounding a little bit on this one. So it just speaks to the fact that central banks so far have maintained all credibility around their ability to basically solve any potential credit crisis or credit crunches or severe liquidity shortages quite quickly. So not too worried about this indicator as well. So long story short, by no means do we want to downplay the significance of this crisis. It is shocking us on the day. We are highly concerned, but from a pure economic point of view, we surely are not complacent about the implications, maybe the implications on inflation, on higher oil price and the ripple effect thereof. But from a financial conditions point of view, and that's really the key one driver of returns over the last couple of years, one could argue, from a pure financial conditions point of view, we do see this crisis for now as to remain local. As John Maynard Keynes used to say, once the facts change, I change my view. I would go with that saying. We use real-time data on all of these indicators. We are able to pick up on an intraday basis if the situation is changing or escalating, which might well happen. But it's important for us to go with the facts. And as we speak, the situation has not yet escalated from an economic point of view. Thank you very much for joining us. And we hope you enjoyed this very brief session, and we hopefully all hope together that this crisis will eventually go past us faster than what we all hoped for. Thank you.
Hello, my name is Mikhail Mutala, a fund manager at PSG Asset Management. Today, I want to give you a quick update on our recent presentation at the Meet the Managers Forum on the recent events in Russia and Ukraine. At the outset, we empathize with what the people in Ukraine are going through. But the topic today is how it impacts our funds at PSG Asset Management. At PSG, our funds have to a large degree been beneficiaries of recent tensions and the knock-on effects thereof in Russia and Ukraine. The reasons being is that going into the turmoil, we were positioned in supply-challenged areas or sectors that were being offered to investors for cheap. We, in the Meet the Managers presentation, spoke to sectors such as the energy sector, the fertilizer complex, as well as the shipping industry as three examples of supply-constrained sectors. All of these sectors, or all three of these sectors, had further supply challenges as a result of the tensions and turmoil in Russia and Ukraine. If we pause on energy as the major example, Russia is a significant exporter of crude oil. And needless to say, with potential sanctions on the horizon, it has tightened an already tight market supply. It's also focused investors' attention on the fact that energy has often served as a geopolitical hedge, if you will. And that was masked during the time of COVID-19 and that crisis where demand fell off a cliff, so to say. Whereas now, with demand having recovered, any turmoil or any disruptions to supply at least result in much higher prices. Another factor I need to mention is that we at PSG had no direct exposure to Russian equities. Russia, much like China, has struggled to get through our governance process that we talk to when we discuss our 3M philosophy. And for that reason, the funds had no direct Russia or Ukraine exposure. And any indirect exposure at a fund level is immaterial and therefore has not significantly affected the funds. We cannot forecast any future outcomes from the turmoil. We are also reluctant to be drawn into considering what the second order effects are, as we would not know what the outcomes of those second effects would be. But herewith, as the information that we have today, the funds have been well positioned through this crisis, and we do not expect any further downturn. Thank you.